Joining me today is E.B. Tucker, author of Why Gold, Why Now, and director of Metalla Royalty. E.B., welcome back to the show. It's a pleasure.
Thanks for having me.
Your book is the gift that keeps on giving, because every time I read a new chapter, I learn something new and I have something new to talk about. I want to start by talking about the chapter you wrote on the broken system that we're living in. You said that the U.S. system used to work, but is no longer working. Tell us about that.
Well, I mean, yeah, you're taught as a kid that it's a capitalist system and it's better than a system that has too much state control. But then if you forget about that and turn on the media and really take an assessment of what's happening. I mean, if you had gone to sleep 50 years ago and you woke up today, you would have thought, I must have landed in Moscow. I mean, I'm not sure I'm seeing this correctly, right? I mean, because the state has so much control. And then you look at the big companies. You have 4 companies in the S&P as of last week that were bigger in market cap than 385 smallest companies in the S&P. And you have distortions that people from generations past wouldn't believe in. David, let me just put it to you like this. When I was growing up, I talk about my grandfather was my mentor in the book and taught me about the stock market and everything. And he was a banker and all this. He had a great career. He would talk to me about the secret to getting rich. It's to spend less than you earn and invest the difference. Very basic, okay? But the problem is, if you had saved $1 million 25 years ago and bought treasuries, you had 70 grand a year in income. You could have retired, lived as decent of a life as any average person in the US. Now, you need $10 million to get $70,000 in income off treasuries, and 70 grand is going to do very little for you. I mean, you'll be playing golf at the cheapest municipal golf course in the area, and you won't even be doing it that often. Okay, so my point is that the standard of living has been under attack. And so free markets would allow you the opportunity to position yourself, and there would be corrections in these things. This system rights itself like a forest fire, clears out the bottom undergrowth in the forest. We don't have that anymore. That stopped about 20 years ago.
You're right. The government has been involved in our day-to-day, but can't you say that's just Keynesian economics? The governments are just spending to stimulate the economy. Isn't that some would argue that's actually a good thing.
You can call it whatever you want. And I also don't think it's a bad thing. I think it is what it is. I mean, you have a $5 trillion budget deficit between 2020 and the estimated 2021 deficit in the US. Meanwhile, you have $12.5 trillion worth of gold in the whole world. In the whole world, there's $12.5 trillion worth of gold that's been mined since the beginning of time. And yet in the US, you're going to have about 40% of that value in 2 years in deficit spending. And so what happens is that you pin interest rates at zero so that you can keep borrowing. So you hear the message, everybody, keep borrowing, because you've got to keep pushing money into the system. See, David, the reason why you like the book is because it doesn't just say this is going to happen on this day. It says there's a series of dominoes that are going to fall, okay? And they're going to hit each other like this. Click, 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 click. And we're only about a third of the way into that. And so if you want to know what to do to preserve wealth and to survive in a state-controlled system, you've got to see what the next dominoes are to fall. And that's why the book's important, is because it shows you the whole playbill. I mean, you got to watch the whole play to see what's going to happen. You don't just want to know what the ending is. It's about how the plot develops and who's going to get hurt. And there's going to be a lot of people, sadly, that are hurt very badly in this system, because this is not traditional market-based capitalism. This is a situation where the system has the power to pick the winners and losers. Some junk bonds get bought by the Fed. Some junk bonds don't get bought by the Fed. Interest rates are pinned at zero for some borrowers, their market rate for other borrowers. You see how this goes? Are you going to be in the in club or the out club? In a communist society, how close you are to the center is very important. In fact, if you have an apartment in the center, you're considered to be part of the Politburo, right? You're close. This is the way things are going. If you're close to the Fed, you get to sell junk bonds.
Okay, so how is the rest of the play going to end? The rest of the 2/3 of this story, where are we headed now?
So as this goes, people are going to slowly realize that, like I was saying about saving up, $10 million to earn 70 grand in interest, it's totally impossible. I mean, how would my grandfather today tell me, just get a job and save? I mean, who can save $10 million just working. So you have to speculate. So it's going to turn everyone into a speculator. Now, gold has not seen that speculative mania yet, and that's coming. That's ahead of us still. That's why we had the $2,500 gold target for this year, which I want to revisit that with you. Our target for the end of the year is $2,500. Now, we're not saying gold will finish over that. We're saying gold will touch that by the end of the year. It's a very important distinction. We think silver hits 40. Think about that. That's a 62.5 to 1 ratio, which is about the historic average. $2,500 gold and $40 silver. These markets haven't become speculative yet. They're just now starting to see serious cash flow. Berkshire Hathaway. Now, I don't know if you know this, but if you bought an ounce of gold on January 1st of 2000, and you bought the equivalent number of dollars worth of Berkshire Hathaway, gold outperformed Berkshire Hathaway. It outperformed Berkshire Hathaway stock. So Buffett doesn't pay a dividend. Gold doesn't pay a dividend. Okay. You can look at these things fairly equally. And if you just bought physical gold, you outperformed the world's most famous investor. And now he's buying Barrick Gold. Why is he buying Barrick Gold? Because the operating margin is twice Microsoft, because the dividend yield is higher than Microsoft, because the company's fundamentals and metrics are far superior to the other companies in the market that have been levitated. He's on to something, and it's going to go farther. There's going to be more of this.
So you're assuming that silver is going to outperform gold. Why is silver going to outperform in the next couple months?
So silver's got some catching up to do. One of the things about silver that people need to understand is that the supply of silver is not elastic. And then what that means is the price goes higher, the mines can't just turn it on. I mean, only about a quarter of the silver supply comes from actual direct silver mining. The rest of it comes from byproducts and recycling and all these different things. So if a company's mining copper and they produce a little bit of silver and the silver price goes up, they can't just turn on more silver production. Now, gold, can do that. Silver can't. So silver has a little bit of catching up to do. Now, one important thing to remind everyone, if you look back over 25 years, and goldsilver.com just did a great article on this, they looked at the months of the year where gold outperforms. Almost all of gold's performance has come between September and December every year going back. This is an average, okay? Of course, there's been years where maybe it didn't, but September to December is the bulk of the move in gold. I mean, you can say, well, why? We needed to know exactly why that is. It might just be because people come back from the Hamptons on Labor Day weekend and they say, something doesn't look right. So it seems to be this time of year when people start gathering up supplies for the winter. And so I don't want to look too deeply into that, but I want to say, look, this is the time of year when it moves. And also what's going to happen early November? You have an election that people are already contesting the election and there hasn't even been a vote yet. So you have, the perfect storm for 2,500.
Okay, so EB, so just to clarify, $40 silver by the end of the year, just like 2,500 gold, it's going to touch those levels, right? These levels. Okay, right. So I'm curious, why not $50 silver? Because as you remember, $49, $50, that was the all-time high. Yeah. Gold's already touched the all-time high. Why don't you think silver's going to touch the all-time high by year end?
I do think it will ultimately cross the all-time high, but I don't think it'll do that by the end of the year, because I think as these things build, what happens is you pull new entrants into the market each time. Now, nobody's in this market, David, believe me. I'm in this market, in the derivatives market, in the spot market, and through Metallo with the royalty market. Nobody's in this market. So you have a long way to go, because it's like a party. I mean, there's only a few people at the party. The cops don't come until much later when the house is totally filled. We're a long way from that. So this year it's 40. We'll see where it goes from there. I'll come back on here and tell you when we have a target for the 50, but not yet. 40 is plenty of a run from here.
I wonder how much of this run-up in precious metals is tied into your thesis of our system not working. I just spoke to former Congressman Ron Paul earlier last week, and he had said to me that the monetary system we have today is on its way to collapsing, and that he used the words central economic planning a lot to describe the current situation in the United States. Now, we don't associate that word typically with the United States. We think about Soviet Union, China, North Korea, communist countries when describing central economic planning. Would you say those were very strong words, or is there some validity in what he's saying right now?
Well, I don't think he's crazy. I mean, in the book, I talk about the former CEO and chairman of one of the biggest banks in the country who I had a meeting with. And he told me that he joked with a federal regulator once, so why didn't the government set the price of oranges? And the regulator told him because that would reward the bad farmers, and punish the good farmers that produce premium oranges. And the government in the United States doesn't do that. And he said, well, why do they do it with interest rates? It's a really good question, and I think the guy was irritated with him for asking it. But in the U.S., we set the price of interest on capital, and we set it at zero. Soon we're going to set it at below zero. Now, the reason why we're going to do that is because we need savers to take that money and invest it or speculate with it or spend it so that this economy can continue expanding. In the book, we talk about how a debt-based system, it has to keep growing. But something's not natural if it has to keep growing. You're managing this growth. That's what Dr. Paul's talking about. Is this is a system where it's expansion at all costs, not too much expansion, but certainly not contraction. You hear Powell come out the other day and talk about we're going to abandon this 2% target so that we can have more than 2% inflation and make up for lost time. But meanwhile, the rate of return on savings is zero, soon to be negative. So you're going to be losing 2 or 3% a year the way this guy talks. Now, David, nowadays, these central planners in the US are like celebrities. They come on, I have a Bloomberg terminal. As soon as the guy's talking, it flashes all red. Powell says this, Powell says that. 50 years ago, it wasn't like this. You barely knew the names of these guys. I mean, they did, some thinking in Washington, in a nice marble building, okay? But these guys weren't financial celebrities. Now, everything they say is pushed across the wire, and it's an effort to manage this economy. That's not a market-based system. Remember, my friend, the banker, was right. Why wouldn't you set the price of oranges? Because it would reward the bad actors. Look, you set the price of money at zero, you have all kinds of distortions that get created, and then you have to continue applying more and more control to keep the system from breaking down. So this is if it was a market-based system, the people that made bad choices with money would ultimately have to go away and come back, as new market participants. There's a natural purging process in capitalism. That's over. If you're connected, you don't ever have to purge. If you're not connected, you have a really hard time getting anywhere.
All right, so you also wrote that we're no longer living in a free market. I think that's congruent with what Dr. Paul said. I mean, those are some pretty strong words. If we're not in a free market, that also implies that the government is controlling the markets, I guess, indirectly through interest rates and, like you said, monetary policy. Can you elaborate on that further? Why aren't we living in a free market anymore?
Well, look at the situation that happened this week with the options market. You had all this news of the options market driving the stock market. I mean, you had open interest in options that had more power to move stocks than the actual stocks themselves. I mean, a derivative is based on the underlying security. Now, in this case, the derivative is controlling the underlying security. I mean, this has never happened before. This means that the speculation is so rampant. There's so much capital in the system. And there's so much connected capital in the system that seeks an advantage. And you look at the average guy, you just don't have a chance. You don't have a chance. I mean, you're looking at Microsoft, Facebook, Apple, Google. The size of the market cap is larger than some of the biggest countries' economies on earth. It just doesn't make any sense. And then you start looking at the metrics of these companies. Now, guys like Buffett are turning around and saying, wait a minute, the gold company actually makes money. I mean, remember, a lot of these companies, it's not the profits they produce, it's the growth that they'll have, the market dominance, the monopolistic power, the connection to government, connection to intelligence, all these things. I mean, social media, think about it. You've got people walking around snapping pictures with geolocation devices in their hand, telling you everything that they're doing. It's an intelligence dream come true, right? It's no surprise that these companies have become so dominant. Okay, so as we go forward, looking at business fundamentals, business metrics is not something that has played into this market rally that we're seeing. And if it is, you buy gold stocks. I mean, because you look at these companies, they're increasing dividends, they have virtually no debt, they're increasing production, the price of gold is rising, profits look great, costs are under control. Nobody's watching. Why is nobody watching, David? If these guys on the desk in New York were really doing the math, that's what they'd be buying. And I think that's ahead of us. Buffett gave people permission to look at the gold mining stocks. you're going to see follow through from that.
EB, it's important to remember that the Federal Reserve was only around for about 120 years or so. And before that, actually, it was J.P. Morgan, not the bank, the person, Jean-Pierre Paul Morgan, who urged the government to establish a central bank because they didn't have one before. And he was actually personally lending out a lot of money to rescue them from an economic crisis back in the late 1800s. And the government had to realize, well, look, we can't just rely on one person as a lender of last resort. We have to have a central bank. Do you think that role of as a lender of last resort has shifted? And do you think we still need a Federal Reserve today?
Well, regulation and market involvement is inevitable for a system if you want to maintain the system. I mean, I'm not one of these people that wants to throw out the Fed or do all these things. It's not a surprise to me that the Fed is going the direction that it's going. It's the nature of things. Nobody wants to delicately let go of control of the system. And as this progresses, I mean, it's similar to junkie behavior. It's not a surprise, that at the end of the line, things get pretty messy because that's the incentives that are in place. I mean, they're not going to say, well, now we'll let you have a recession. So, for a few months here, batten down the hatches, only the people that have saved capital and are tight operators are going to make it. Any of you guys that borrowed a lot of money, sorry, but you're going to be in trouble. You can't do that. It's because then you end up with just a revolution and you create all kinds of real kind of serious problems. So look, a system's always going to have some sort of central authority. It's somewhat of dreaming to think that you just have totally laissez-faire system. I'm not advocating that. There's always going to be something. But the point is, as the system gets into trouble, you have to be aware of what's going on because your wealth is on the line. The subtitle of the book is The War Against Your Wealth and How to Win It. I mean, think about it. Save up $10 million to retire with 70 grand in income. It's impossible. You're being painted into a corner, okay? So you need to see that you're being painted into a corner and you see what comes next so you can preserve yourself. This isn't about being an ideological kind of warrior to this country should be this, or they should use silver coins to buy groceries. Forget about all that. There's always going to be a system. But now everything has a life cycle, David. We're in the dangerous kind of end of this life cycle of the system. And when that's happening, you've got to preserve your wealth so that you can survive into the next system and not be a serf when things shake out.
Well, the Federal Reserve, as you wrote in the book, confiscated gold holdings in the 30s. It happened to your grandfather, and you offline you were telling me it's going to happen again at some point, right? Why would they do that?
See, this is a $20 bill from the 1920s that entitles you to an ounce of gold. It says at the bottom, in gold coin. I keep these things around to show people because they don't believe me. $20 for an ounce of gold. I mean, now you're at $1,960 and rising. So, and I've brought on camera before, it's about that much money, it's an insane amount. And soon it's going to be two of those stacks, right? So look, it's the nature of the group that controls the money to try to slowly devalue the money. I mean, Powell is telling you in plain English that the rate of return on savings is going to be 0 and the inflation rate is going to be above 2. I mean, you don't have to be an MIT math whiz to realize that if you're going backwards 3% a year, you have to run very fast to not experience erosion. And so the question, David's going to be, can they manage the devaluation gracefully and slowly so that people don't notice? Because if you make 100 grand and I give you a 2% raise and inflation's 4%, you might feel like you're making more money, but you're going backwards. Okay. And we're not talking about this radical inflation for the 70s. You got to look around. I mean, the place where I get coffee raised prices 12.5%. And they told me, they said, look, we have to raise prices. We're running at 50% capacity. We have all these, coronavirus protocols to do. We have to raise prices. You start looking around, you have these little price increases going on all around, okay? Nobody notices. So gold is a safe harbor for some of your wealth during that time. Eventually you'll trade the gold back in and buy something else with it.
Part of the problem you wrote is also low interest rates. And you argue that there's a big problem with zero interest rates. I mean, in theory, it actually sounds quite nice. You go to a bank, you get a loan, you don't pay interest. And so you can really expand your personal line of credit. You can expand businesses if you want. Businesses can expand their operations with very little, very cheap debt financing. What's wrong with this picture, though?
You get too much capacity. So the problem is that it's slowly over time, you got too many luxury apartments. You got too many hotels, too many cruise ships, too many strip centers, right? So what happened was, like, think about the housing boom to make it simple. You made money really, really cheap. They built tons of houses and there were too many houses. So you end up building things that you would not otherwise build if you were saving up the capital and doing this in a market-based system. You would never build 14 spec condominiums and try to flip them to overseas people that were going to reflip them, to an unwitting buyer at some point down. You would never do that. It wouldn't be possible. What would happen is you would have to generate a return. When the money is zero, you generate 1% return, you're good to go. So what happens is you build out so much capacity that you're oversupplied. So this is one of the distortions that comes up. Now, look, picture you're worth $100 million. What do you do with the money? What do you do with the money? You're going to buy an office tower? Forget about it. You can't work in an office anymore. You're going to build an apartment complex? Too many of them. You're going to buy stocks. I mean, Microsoft, trading at 30 times, EV to EBITDA. You're going to buy that? Come on, you're not going to buy that. What are you going to do with your money? You're going to buy a little bit of gold. Okay, that's good. That'll do something with some of the money. You're going to buy a house for yourself. I mean, think about it. It's a real problem. Like, what do you do with this money? There's too much money. The returns have been compressed down to nothing. Okay, so when that happens, everybody is stretching and taking risks to generate any kind of return possible. Now, ultimately, business risk comes into the picture. Sometimes people don't pay you back. They can't carry on. They shut down their operation, and then you're left holding the bag. And nobody has factored that in because they've been so fixated on, I got to generate some return. That's coming.
EB, we only have a few minutes left, so I have one more question for you, which is in regards to one of your final chapters in the book, the most profitable business in the world, which you described as being Franco-Nevada. Why do you like royalty companies so much?
So the magic of royalty companies, which I explain in the book, is that you get a perpetual, non-dilutable carried interest in the mining operation. Now, let's just make sure we don't miss anyone there. Perpetual means it goes on forever. Non-dilutable means the mining company can issue billions of shares, borrow money and do all kinds of crazy things to fund its operation. And it doesn't matter. 1% is 1% now and forever. And so as the gold price rises, the value of the gold to come out of the ground in years ahead increases dramatically. And then the value of those shares goes up. Earlier, I told you that gold had returned 580% since the year 2000, since January 1, 2000. And Berkshire had returned 486%. But Royal Gold, a competitor to Franco, has returned over 3,500%. Over 3,500%. So you ended up with a multiple of the return on gold. So if you think gold's going to perform well, the royalty companies, assuming they're run the way I tell in the book, because it's not just any royalty company, you have to do certain things. You're going to have Pierre on later. He's the godfather of the royalty business. I would quote his performance, but they were not public the whole time. There was a period of time where they were part of Newmont. So, but Pierre knows how to do it because you focus only on gold and silver. You spread out your jurisdiction of where your royalties are, and you stay fiscally tight. I mean, Franco has about $1 billion in market cap per employee. About $1 billion per employee. Think about that. I mean, Google doesn't even come close. Facebook. I mean, these guys are in the millions per employee in market cap. So in my opinion, the royalty business is the most profitable business in the world, the most lucrative business in the world, because it takes very few people to run the business. You need a savvy deal maker like Pierre. I tell the story of what happened in the 80s. He went to Nevada. He realized he was going to go bust drilling forever and issuing 50-cent stock. He bought a royalty for $2 million, and American Barrick discovered a serious monster gold deposit near Elko, Nevada, right through the middle of Pierre's royalty. It's returned over $1 billion in cash. Think about that, 2 million into $1 billion. Now, what does Pierre had to do in the meantime? Well, you got to check the mail in Toronto. You got to have, maybe the lawyer check on things. I mean, there is some work that has to be done, but it's not the type of work that you get into when you're running a widget company that requires constant sales efforts and all these things. The royalty business is, let's just say, it's the smart, lazy man's way to make a killing when the gold price goes up.
Evie, I'll get you on pretty soon to talk more about royalties and mining, but it was a great talk today. Thank you very much for coming on the show.
Thanks for having me.
Thank you for watching our coverage of the Precious Metals Summit. David Lynn here. Stay tuned for more Kitco news.